starting to pick up on this. Since we started writing these articles, there's been a huge amount of development in the gold market in just that short space of time. We've had a huge amount of attention paid to backwardation, to developments in the Bank of England and gold, and also, of course, the major controls going on in India, which just seems to just be the start of yet another gold war. It is worth noting, of course, that India has been having had gold controls since 1947, but never to have such a dramatic effect that we're experiencing at the moment. So many analysts have used this development in the drop in the gold market and in India as a sign that the bull market is over. But as I alluded to at the beginning, we think that our research shows that this isn't the case at all, and it's just the nature of the gold bull is changing. So the first of our research reports was called Unveiling the Gold Market's Working Parts, which I think you've been provided a link to in the Google window. So if you have a look at that if you want, but we'll try and show you some of the graphs as we go throughout. We did this quite high-level, broad look at the gold market, mainly to provide a view to those who are unfamiliar to all the different elements that made it up, but also for ourselves. You know, I've only been doing this for a couple of years, and it was a really useful tool to see all these different cogs that took part and what were the bigger cogs and what were the smaller cogs driving this price. It was obviously clear from the outset, as we'd all been talking about in the month before, that the gold market was heavily weighted towards financial products that track the gold price rather than perhaps physical gold. And of course, because the report was released just 1 month after this gold price, it was clear that that COMEX was going to be a major focus point. So the first area that we looked at in this first piece was the futures market, and this was particularly interesting to look at because Terence Duffy, who I've quoted many times, he's the chairman of CME Group, said gold products, these paper gold products, they just wanted to own physical gold. So when we looked at COMEX, we found that COMEX represents around 85% of this $75 billion market that is the gold futures market. And so it enjoys this liquidity monopoly of these exchanges. And so it's unsurprising that we were very quick to jump to the assumption that this is where the heart of gold price discovery was. And I think given April's actions, that was a very straightforward conclusion to come to. And given that these several large sell orders appeared in April when over 120% of annual gold supply was traded in one day, and the gold price plummeted to a level 30% below the all-time high, then, like I said, COMEX was the obvious place to point towards. COMEX's contract is not accessible for individuals, so I don't believe that this is a true representation of individual gold demand, and it suggests that people and physical gold is unable to compete with this huge market. And we will come back to COMEX shortly. That's the next piece we're going to talk about. Then we looked at ETFs, which is a significant player in this space, but this is interesting because ETFs only represent 6.5% of total gold demand each year, according to the World Gold Council. But it is a match for COMEX because the gold ETF market is worth about 81.2 billion, and GLD alone accounts for 60% of this market. But having said that, COMEX is 20 times larger than GLD. But GLD, to flip it around and confuse it all a bit more, is GLD is bigger than COMEX in terms of notional value of open interest, and looking at the market cap of the ETF. We will discuss the ETF in more detail, and this is interesting because the World Gold Council do believe that ETFs have a significant impact on price, and I think, in my personal experience of just reading the mainstream media, that following the gold price crash in April, it would seem to be heavily blamed on ETF outflows. So this is quite interesting given the small percentage of the market that it represents. We then went on to look at refineries. Will did an amazing infographic that showed how all the refineries, the major top 10 refineries around the world. And we looked at this because clearly the refineries are the major supplier on the market. This is where recycling gold mines comes through. And this was to try and get an idea of the pull between demand and supply coming onto the market. There were and continue to be, but we have no evidence of a tightness in supply coming through the markets. And since then, rumours have abounded of the movement of 400-ounce good delivery bars coming from the Western world and being refined Like I said, we didn't find any evidence of this. What we did find interesting is the major capacity of the total capacity of all of these major refineries was 8,000 tons. That's double what the on average total gold supply has been during this gold bull market, which is around 4,400 tons. And of course, I think many of us would have expected Switzerland was the most. They owned the gold refinery market, and the top 3 gold refiners currently sit in Switzerland. Perhaps not that surprising given that the country didn't officially come off the gold standard in 2000, and that they account for 30% of this total annual refinery capacity. Just as a side note, we weren't able to get data for the Asian or South American refineries, so that this is a slightly distorted picture, but I can't believe that the Swiss refineries would drop hugely in that table when these other refineries were added in. It's very different the trading, so it was tricky to quantify, and at first glance when we compared the production capacity of these refineries to GLD and well, to the ETFs and the futures markets, they looked very comparable, and and the refineries actually were able to produce more. However, in the week that we studied, which bearing in mind was in mid-May, the value of gold traded on COMEX was 20 times larger than that of GLT. And the annual capacity of the main refineries was around 374 billion. And so this actually shows that the total gold traded on the week that we examined on COMEX was 50% of the annual refinery capacity. So that's about 4,000 tons going through, because refineries can produce about 8,000 tons. So it's not surprising, and as we'll talk about a bit later, that people are wondering really how sustainable is COMEX and how much gold is back in COMEX. So just to sort of pull back and look a bit more about the values that go on in the markets, whilst the notional value of open interest on the world's major futures markets is comparable to the market cap of the ETF industry, the volumes traded at these 2 major liquidity hubs are very, very different. And again, there is a graph in this piece which does show you. The dollar trading volume at COMEX is also far greater and than its largest ETF competitor, which is GLD. And so COMEX does continue to be this liquidity and the most sophisticated meeting place for the gold market. So phase 2 was looking at COMEX, which we'll come to in a minute. But if any of you have any questions or anything, then pop them in and we'll have a chat about it. Is there anything you'd like to add, Will?
No, really just to add what you said earlier, Jan. The gold price crash got analysts all around the world talking about paper gold versus physical gold, gold price discovery, where does it happen? And we, like Jan said, we thought we'd do a very high level look at it first, so we looked at the world's futures markets. It was amazing to see COMEX's liquidity monopoly there. The 2, small players who accounted for 7% of the market together was actually Tocom and the SGE, it's in Shanghai. So that was a pretty serious liquidity monopoly. But as Jan said, it was that weekly volume data of COMEX versus GLD that showed that 20 times the trading in dollar value at 3 or 4 sample weeks that we looked at. Unfortunately, we couldn't get any data going further back than that. But we thought the 3 or 4 weeks were relatively representative. So that was an interesting conclusion for us. And like Jan said, that was the first look at the market globally without focusing too much on the Middle East, and that brought her on to her second piece, which we'll talk about in a minute, COMEX. But for now, we've got a range of you in the Hangout. We can see there. Welcome. I hope you're all enjoying it. If you've got any questions, feel free to unmute yourself and step in, maybe one at a time if you can manage that. Or there's obviously the chat facility there on the right. So if anyone's got any questions about that, please feel free to go.
I have a question.
Hello.
Hi, Koos.
We talked finally.
Jan and Will, so nice to meet you. Can you hear me?
Hello.
Hi.
We can hear you.
We can hear you really well.
One question right now. What's your next research? Are you do you have a few more topics to research? Maybe Dubai is an interesting gold market, as 20% of the physical gold being traded yearly is going through Dubai. Or Russia maybe, which is a big buyer. Do you have any further plans for your research?
We did, well, yes, because I saw that you hinted in a question the other day on Twitter that you wanted us to look at the DGCX. Dubai is certainly on our list. Our boss, Rafe Hazel, who's one of the founders of the company, has a lot of experience in Dubai, and we have some contacts that we'll be talking to, and we will be hoping to have a lot of research going through that. So yes, look out for that next, which will hopefully be the feature of our next Google Hangout. Yeah, and Russia, yeah, that'd be great.
And really, to add there, Koos, yeah, Dubai, a fascinating place to look at, but as much as anything, because it's become like the modern-day Casablanca. It's become a real haven for gold flowing out of Africa in dust and dory form into Dubai for refining. Yes. It's a massive market, yeah, and really quite a misunderstood market, I think. So that will certainly be something we can look at in the future, and who knows, that might just be a few weeks away.
Are there any other questions? I think this over the overview piece there's probably not going to be any questions on, so should we go on to the COMEX?
Yeah, unless there are any questions from the Hangout, let's move on.
Okay, so as I concluded on the last piece, that COMEX was the next port of call. It was quite obvious given the amount of attention that it was getting. I don't think particularly in the mainstream media, but certainly in the research that we were reading, or the podcast and everything, people were talking about this sudden dumping of gold on COMEX. Again, a little bit of a disclaimer here. When this was our most popular piece of research in terms of comments that we received, both on email and at the bottom, and you can read them. Some readers were particularly upset that we hadn't gone down into blaming central banks or governments on what happened on COMEX. We very much wanted to present the data that we found rather than anecdotal evidence, but we do understand that people have heard other things have gone on, but what we're about to talk about is just the data that we looked at. But we are open to, send us any emails and anything you found, great, because we'd love to, look at this further. So it's often argued that because it's mainly paper traded on COMEX, that only a small percentage of this paper gold can ever be delivered in physical form, and so this is, given the huge volumes that go through this is the most flawed part of the gold market, and so it's completely wrong that it's the center of, it has so much power over the gold price. But we chose not only to look at COMEX because of this huge dump of contracts back in April and because of its size, but also because a lot of people were talking about the drawdowns in the warehouses that were going on, and so this led many to conclude and discuss, including Eric Sprott, that contracts soon would only be available for cash settlement. In fact, Eric Sprott said that the chances of this happening, he believed, were about 100%. So we decided to look at this. We looked at open interest. For those of you that are unfamiliar with the phrase open interest, this is the total number of contracts that have not yet been settled in the previous immediate period. So when we looked at this, open interest on COMEX actually reached a peak at the end of 2010, and it's never reached similar levels since, which may be surprising because the market is growing. So at the time of writing, many people did appear concerned that the level of open interest was climbing. So first of all, we concluded that there was no downward trend, however, in this activity, and market participants did and still do appear happy to be bringing their business, and they don't seem too concerned about the risk of cash deliveries on this, which again, when we were talking about the nature of the gold market, we are seeing the gold price and people wanting to own gold. I don't think people are coming to COMEX to take delivery of gold. And speaking of participants, this is something that we'll look into, so you might want to jump in a minute. But neither commercials nor non-commercials on the exchange seem to have lost their appetite for using this marketplace. We expected to see commercials both reducing their long and short positions, and in fact for commercials we found their short positions have been falling since 2013. Looking at some data today, this seems to have fallen again slightly, and long positions have been growing. This data seems to be on the turn, but only just this week, so I don't think we can quite call it a trend. Is there anything you'd like to add on this?
No, not really, Jen. Yeah, that was interesting to look at. That was actually the deepest historical data we had. Yes, open interest was down about 30%, but it wasn't in unprecedented territory. It's significant, but not unprecedented. The commercials we thought might have been the smart guys getting a sniff of if there are any problems first. They weren't really reducing their participation. At that time, this was about 2 months ago now, they were actually reducing their short positions as the non-commercials were reducing their longs. But as the market goes, it looked as if it was functioning okay, and then Jan got into other things like the delivery ratio and the cover ratio, which she'll talk about now.
Yeah, so as I said at the beginning, one of the other areas that interested us, that led us to look into COMEX, was these warehouse stocks. And so when we looked at this, which was of course May, so I think we did this about the beginning of June, this particular research piece, the gold in warehouses was not at a record low, and in fact it was far above the warehouse stocks seen since the beginning of the gold market, like the bull run of gold. But of course, the market is much larger now, and so greater amount of ounces are represented in open interest. So these falling stocks can represent an issue should open interest not be falling in a similar. So is there physically backing it in the vaults? Yes. The shortfall of gold stocks, however, has been something that has been freefall since, well, not in freefall, but declining slightly since 2009. And previous to this, registered stocks were either in surplus or the two tracked one another. And there is a graph on the in this piece, which is the second piece of our series, which you can have a look at. This is a relatively new phenomenon. It's going on since 2009. And so this is where people are asking, is this placing COMEX under some stress? Even if the deficit has been greater, which it had been since then. So to assess this further, we looked at the cover ratio, which tells us what percentage of gold is actually backing these COMEX obligations. And to find this, we used Brian Lucey's data, who's of the Perth Mint. Brian Lucey, by the way, you should follow his research. He's been really helpful in all of this research. It's a shame he couldn't join us today because it's been very useful, and I suggest you look him up. So we took Brian Lucey's calculation to calculate the cover ratio, and we inverted Nick Laird of ShareLinks, I'm sure all of you know who he is, his owners per ounce calculation. Though again, this graph is available in the piece if you'd like to look at it. The results were interesting. So whilst the cover ratio is significantly lower than previously seen and has been declining since mid-2006, in May 2013, the cover ratio fell from 7% to nearly 5%, and this is the lowest level since August 2 years ago. And that was when we saw 3 consecutive delivery months where cover ratios were particularly low. Of course, this was in the run-up to the peak gold price. But this means that current market action is notable, but it's not unprecedented. So I wasn't really following the gold market 2.5 years ago, but as I'm aware, this is sort of the biggest fuss that's been made about the amount of gold available on COMEX at the moment. It is worth noting, just again as a side note, that when analysts refers to the cover ratio, they use total gold stocks, registered and eligible together. And we are aware that COMEX warehouses freely reclassify one into the other, but we just decided to look at it just using total gold, using total gold stocks for now. And then the second way, okay, again, we sort of wanted to find, is COMEX sustainable or not? You know, we kept hearing about it, so we looked at it further, and we asked, is there another way to measure sustainable COMEX? So we looked at the delivery ratio, which is looking at the ratio of contracts standing for delivery versus the open interest, which we discussed earlier on. And this figure shows you the percentage of traded paper gold taken to delivery. And again, we have to thank Nick Laird from ShareLinks, because we wouldn't have been able to get half of this data if it weren't for these people making it available already. And as you can see from the graphs in this piece, we found that in order for COMEX to come under any stress, the delivery ratio would have to increase significantly. And this could happen, but again, we would need to see a notable change in the nature of the trading activity that's going on this exchange. And as I said before, I just don't get the impression that people are using COMEX in the same way that we understand to own gold for. And the highest peak of delivery of COMEX was actually back in 2006, and the ratio is nearly 11%. And now we're looking this year at the percentage of those taking delivery of about 2 to 3%, which, as we talk about the Shanghai Gold Exchange shortly, you will see that this is actually unbelievably low compared to somewhere like the Shanghai Gold Exchange, which exists for physical ownership. So we believe that it suggests that the drawdown of gold stocks and the fall in the cover ratio is not really the problem that has been suggested. So we carried on pushing, looking for this stress, and we tried to establish if enough deliveries are occurring to drain these registered gold stocks. And despite these inventory drawdowns, the small fall in open interest and delivery contracts means that the difference between the two ratios is just relatively constant since the end of 2011, really. And so as things currently stand, believe 50% in order to put it under stress. And again, I'd like to come back to a lot of people did take issue with these findings. Please send in what you know, because we would love to look at this further and find something more significant. So there is no doubt that the warehouse stocks have found some decline, but this trend is in line with other trends exhibiting themselves on the COMEX data that we were looking at, and we don't find that market participation is particularly collapsing, which is perhaps bad news for those of us that want to see more people owning physical gold, but that market does, for the time being, seem to be in demand and is alive and well. But what we did find is this decline in gold stocks and the open interest falling, that is not falling, that the amount of paper backed by gold, tangibly backed by gold, is falling, and this is important. And so whilst these levels aren't unprecedented, it is something that needs to be kept an eye on, along with the delivery ratio exceeding the cover ratio. We all know that being a fractional market, COMEX is vulnerable to runs, but at this time it does continue to function, and it does still hold this liquidity monopoly to Western investors. I'd just quite like to just very quickly bring in some of the issues and comments that were mentioned. That one person brilliantly brought to our attention that after writing this piece, COMEX, and I doubt because of us, but put a disclaimer on their data, which states that the information in the report is taken from the sources are believed to be reliable, and they disclaim all reliability with regard to its accuracy or completeness. So take what you will from that. Many people suggested that what really needs to be done is to have an audit carried out. We couldn't agree more. And really what needs to be happening, as Will pointed out in one of the comments, is that we just need, in order to destabilise this this market, is we need more traders requesting delivery. But at the moment, speculators seem happy to play, and they don't see it as a place to be buying physical gold. Is there anything you'd like to add?
No, not really, Jan. I mean, COMEX is one of these enigmas in the gold market, which has people talking all the time. And as you said earlier, this was our most read research piece ever. Had 40,000 people read it from around the world within about 6 weeks, and we're still getting people reading and commenting on it today. So it was, obviously something that people wanted to hear more about and see what was going on. And it was a great segue into your next enigma in the gold market, which we'll talk about in a sec after anyone else's questions, the infamous London gold market.
And the London gold market, again, I think this is the last time we'll refer to him, but we were suggested that we looked at the London gold market by Bron Seceki, because he not took issue with, but suggested we looked more into this idea that COMEX was the heart of gold price discovery, because in fact other research, which is carried out by Professor Brian Lucey, who I see Joyce joined us about 10 minutes ago, he's done a lot of work into this, so it's quite an interesting thing to look at. Have any questions come in, or has anyone got any questions?
I have a question.
Okay.
How do you see or do you see the Shanghai Gold Exchange having an impact on the COMEX and the LBMA? Are they going to completely drain both of those markets, if you will, for lack of a better word? Or where do you see that? Where do you see that headed?
Well, actually, I'm going to answer your question, but in about 2 pieces' time, because we're going to look at the Shanghai Gold Exchange. Okay. So I'm not trying to put you off or anything, but hopefully that will answer your question. So, but well done for jumping the gun, and we'll get there soon, I promise.
I think Koos might have something to say there as well.
Koos? No, well, maybe Koos will be joining in with us then, and he will, no doubt. I'm putting you up for this, Koos. He can answer your question then.
I have another question too.
Okay, great.
Yeah.
And just to introduce myself, I don't know if you see it as John Smith, but my name is Rory Hall, and I'm with sgtreport.com.
Oh, hello.
And it's very nice meeting you.
And you, we're regular readers of the site.
Yes, and the question that I have is regarding an interview that Hugo Salinas Price did on King World News a few days ago. And he was discussing an insurance policy that Morgan Stanley, JP Morgan, and everyone else, there's no one else writing this insurance policy, and it was for a price movement between the time of the contract or the time the person made a purchase to the time that they actually took physical delivery. And there was a policy that was written for, somewhere between 3 and 5 days. They're no longer writing that. and I'd never heard of this before. And what is your take on that? It's because to me it sounds like there's somebody that's scared to death. You know, if they're all abandoning ship all at one time.
Yeah,
or are you familiar with this policy? Like I said, I'd never heard of it before.
No, Rory, that's new to us. I mean, we're big fans of Hugo Salinas Price as well. But I think really, if you look at the last 6 months of pieces of anecdotal evidence or data, that's just another straw to add to this story. So, you know, you have, as Jan said earlier, you have Comex, you know, issuing a disclaimer about actually their data. All of these things add up. So I'm afraid we haven't actually listened to that interview, although we do listen to King World News. But you know, without knowing all the specifics, if I was an investment bank right now, I'm not sure I'd be wanting to write insurance on such an event.
Exactly.
or probably anyone in this conversation.
No,
this was their policy. It was a policy that they had actually come up with, and now they've abandoned it completely.
Well, no doubt it was a great money spinner for years, traded OTC, but now maybe no longer.
Hi guys, Richard, just wondered, are we waiting for the Chinese and the BRICS nations to actually, like a sovereign nation, to make a move before anything changes on the prices and we break away from the paper price?
I think this is something that we definitely need to be looking out for. A lot of people are saying that you know, it's going to take Comex to collapse, or you know, more issues with London. But I agree with you. I think people are underestimating the power that the Asian and the emerging nations have. We actually did a research report which was released the day before the gold price fell in April, which was looking at the power of the BRICS nowadays, because they are looking at having this single currency between them in order to trade the singular reserve currency. They are all holding gold. Who knows how much China have? I said a few months ago and was mocked for it, saying that China probably got about 6,000 tons, but it's perfectly possible. And you know, there has been, I think, probably in the last 3 weeks, quite a few pieces coming out in the mainstream media about whether or not China are looking towards moving towards some kind of gold standard. So I think that will be interesting. And I also think as relations tense between the West and the East a bit more, that we are going to see more international trade happening with gold. And again, I think this is these moves to be looking out for, rather than this pressure on the paper market. What do you think?
Yeah, Richard, thanks for your question. I heard an interesting interview with Eric Sprott the other day where he was suggesting that physical buying in Asia is becoming a real problem for Western central banks, who might possibly have leased a bit more gold than they wanted to, or actually not have control over gold they thought they did. Eric's thesis that he's been talking about for a number of years is that central banks have been trying to keep a handle on the market, and that their cupboards are pretty dusty. I think this is his exact quote. He has an opinion that India, being an ally of the West, is coming under some pressure from powers that be in the West to take measures in their market to stop the huge offtake of physical. So we've all seen in the last few months all sorts of measures, whether it's tax on imports, tax on trades, and in fact just today when we were preparing for this hangout, we see that the spot gold market in India.
Oh, they've restricted all trading on it. They say it's because there's some irregular trading action going on, but it all just seems a little bit too good to be true, given the controls that have been, you know, just ramped up in this last year. But it was also on silver as well that it was going on, not just on gold.
I think really,
I was reading. Sorry, I was reading Stephen Lieb, and he was saying that China have been importing about 104 tons a month, so they're on track for 1,200 this month. And I agree with Jan. I think it's more than 6,000 tons that they've got. And I don't think America will ever have an audit, and I don't think the US will ever want anyone to go to Fort Knox and show that there's nothing in there, because they can't afford the public panic. Because when gold does readjust, and if we do go to a new currency by 2020 or whenever that magical date is going to appear, I think people need to believe in the fairy tale that they have it, so that they can reprice their debt accordingly. So it seems to me that however hard we try, we're just waiting for a major, and it looks like everyone's lining themselves up to position themselves to be in a position to hold enough gold to be able to benefit from the next few years. So it seems to me that we're waiting for a sovereign nation to make that big change, and until a big player like Russia or China actually, and they can make a claim on the COMEX tomorrow and bankrupt it, and I don't think the COMEX will ever default. They'll just change the rules of how you can get the gold or this, that, and the other. So I don't think it's ever going to default. We're just waiting, I think, for a major sovereign state to make that challenge.
I agree with you, and I think with the COMEX thing, like we said earlier on, just these rumours of cash settlement are more likely than them sort of defaulting completely.
I agree, Richard. I think, you know, people have all sorts of opinions about this paper versus physical gold debate. Eventually, it's all about the physical. So if these Asian nations are taking it off the market at such a rate, at some time something will happen. Who knows where and how exactly, but you know, the evidence seems to me there that they are taking it off the market at one hell of a pace.
I think Koos has a question, and then I'd like to move on to London because I'm just a bit conscious of everyone's time. So Koos, were you going to add something?
Yeah, I was just asking something, but it was about China, so maybe it's better to ask it if we discuss the SGE.
Okay, yeah, that's a great idea. Okay, so as I said, Bronsachecki suggested that we look into the London gold market, and I think possibly more than COMEX at the moment, London is a real source of much discussion on many of the gold blogs and podcasts going on, partly to do with backwardation, but also sort of talking about, you know, we've actually run out of gold, and the Bank of England have sold a huge amount. As I said, we originally suggested that COMEX was the heart of the gold market, but given the size of the London market and the twice daily fix, one might assume that it actually has a greater impact as well. However, given, as we've said several times, the nature of the sudden fall in April, this clearly wasn't the case at present, that London had this larger power. In 2011, the London gold market accounted for 86% of total activity within the gold market. And just to give you an idea of the comparison of these size, COMEX just accounted for just 10% of this. I just very quickly like to say a lot of the data that we're talking about, not much of it came from the London gold market from the LBMA. A lot of it came from Professor Brian Lucey, who's joined us because he's been given some great access to some of the data, and so we were so lucky to find his and his colleagues' research. So I'm very grateful to you, Professor Lucey. So the London gold market is an OTC market, and it accounts for over 90% of all of this activity. And 90% of their activity in 2011 was spot transactions. And as we said, in contrast, COMEX in New York was just 10% of this activity. Unlike COMEX, and I know I just said that COMEX contracts are large, but unlike COMEX, London is entirely inaccessible to individuals, and the minimum amount of gold traded is 1,000 ounces. It's actually very difficult to ask whether or not this market was unsustainable. It's inherently opaque. In our research piece that we did on this, there's a great quote from the GFMS, which basically sort of say, yeah, it's completely opaque. They don't want analysts and journalists looking into this. And we even, you know, talked to a couple of people that tried to contact them in the past, information, which does give rise to lots of questions. Well, why don't they want to share this information? It's been estimated that 95% of all the activity that goes on within the London OTC market is unallocated. We haven't found any evidence of that. I can't remember if I read that in Professor Lucey's work, forgive me if it wasn't yours, or in the Thunder Raid report, which is also a really great place to take a look if you're interested in reading about this more. The subject of how much gold backs this is, it's an exchange. It's not an exchange. Members aren't required to report turnover, and so the only regular statistics to come out of the London market which we could possibly derive any meaning from are the net clearing statistics, and this is designed to give you an idea of the amount of gold, the volume of gold traded in London, but as we've such as ourselves, but also members, they did suggest clearing statistics just show a fraction of the volume that goes through. And this is down to the netting of trades. And rather than go into it, there is an explanation of this in the report, so please take a look. There's various estimates, therefore, of how much we should multiply these clearing volumes by in order to get a real example. And so we've read anything between 3 and 9 that you should multiply these statistics for in order to get an idea of the volumes going through. We picked the number of 5 because it was sort of in the middle, and we'll come back to this. And in the work previously carried out, as I referred to before, this data was calculated using these one-off statistics provided by the LBMA, and so it was tricky to us to get an idea of this data, which previously had access to, and it had been annualized by Professor Lucey. Now, interestingly, like we suggested, they found that COMEX was the dominant point of price discovery, and part of this conclusion was that they found, and if you'd like to jump in, Professor Lucey, please let us know, because it would be great to hear any more thoughts you have on this, that because of the vastly more transparent nature and this constant flow of prices and daily volumes and information coming through, that this is why COMEX was as powerful as London, if not more, in setting price discovery. So as I've said, it was tricky for us to look at this, and even the people that have looked into this before said that it was tricky for them to figure out of London and COMEX who leads the dance, as they put it. So they almost go as far as to say that the size and dominance of the London OTC market can be misleading because of this opaqueness. So we had to start asking, well, is this sustainable, and what is the volume of it? And as I referred to before, we took the clearing statistics in a multiple of 5, and we tried to gauge a more accurate idea of the daily volume passing through the London market. Now, there's one of the first graphs in this piece. You can see that without using these multiples, the London market is still significantly larger than COMEX. And you can see that the ratio of London market to COMEX has been prevalent for several years. And this does complement findings that were found before, that the London market did dominate price discovery throughout the Lehman Brothers crisis before switching back to New York, sort of post the hub of that crisis. But what's really interesting is when you apply that multiple, which has been suggested by several people, that the dominance of the London gold market is significant. You can see how much bigger the daily volumes are going through COMEX. So we did ask ourselves, is it under any stress? What's backing this? But again, this opaque nature means that you cannot find out the true value, the true amounts of gold backing these unallocated accounts, and how much is gold held by clearing members, etc. So we're unable really to comment on the stresses placed on the London gold market. But as we all know, I've that information elsewhere. And we do like a challenge, so we speculated using the daily gold production figures and the number of London good delivery bars. So in 2012, we were looking at about 7.4 tonnes a day being produced, which for those of you that want the ounces is just under 250,000 ounces. So assuming actual gold transfers within the gold market are actually 5 times more than reported, then believe it or not, the total amount of gold transferred within London is on average 426 times daily gold production. But when you look at the market in relation to London good delivery bars, which, believe it or not, there isn't an official amount of London good delivery bars, which seems shocking. We estimate there's about 15,000 metric tons. There's a value of an average of 5 days trade on the London gold market, matches the total potential stock of London good delivery bars. So given that our previous research has found that the COMEX cover ratios we discussed just before is between 3 and 6% last year, the activity in the London gold market seems to be far, far less sustainable than COMEX. And so should buyers and central banks wish to take delivery of their unallocated gold, they appear to be in a far riskier position than they would be if they were on COMEX. And I think this supports a lot of what people have been discussing, particularly in recent weeks. So this did change our view that COMEX is always the heart of price discovery. But of course, at present, I don't think there's any doubt that this is the case. COMEX remains in this. Professor Lucey and colleagues found, and they find any economic or political reason for this doing so. And they think the average share of London share of price discovery switches between 45 and 55%. So we see at times that sometimes price discovery is shared, and other times when it's concentrated in other markets. We hypothesize that what's actually driving the movement of gold price discovery between the two markets is confidence. And as we've just said, we believe that London at the moment is far more unsustainable than COMEX, and we think that because COMEX isn't immediately available to any major stresses, that at the moment COMEX is the market of choice between the two in terms of price discovery. That was a very brief look at the London gold market because I'm aware of time. If anybody's got any questions, please go ahead. Otherwise, I think what everyone wants to hear about is the Shanghai Gold Exchange. But if anybody wants to shout, I think we should have dedicated a whole Google Plus Hangout to the Shanghai Gold Exchange and just invited Koos over here. Have any questions come through?
No, not any questions here, Jan. But as you say, the fascinating thing about that comparison between COMEX and the London gold market is that some might assume that the bigger market has to lead the dance, lead the price discovery. But as you say, it really doesn't. It does oscillate between 45 and 55% of the dominance in price setting. So investors are obviously liking the transparency and data they can get from COMEX, if you, relatively speaking, perhaps, compared to other things. So there's just some interesting questions there about the future of the London gold market and how it works and how it functions generally, because if investors are telling you there that the smaller market with less liquidity still attracts more price discovery, perhaps that's just another thing for London going forwards. I think there's some interesting quotes you said and you found in your research from various people that the London market suits some people, but perhaps it might not suit a majority of market participants.
Yeah, I don't know if Professor Lucey would like to add anything. There's no pressure to if you don't want to.
I've just seen, actually, I think sadly Professor Lucey's had to leave.
Oh, he's had to leave. Oh, I obviously wasn't impressed.
Anyway, thanks to him for joining for a while. Dinner's probably ready.
So we will move straight on to Shanghai Gold Exchange because I know this is what everyone's looking forward to. I can't take any credit at all for the work that we did on this. Koos Jansen, who I suggest that you'll follow on Twitter and take a look at his blog. You can find him on Twitter as In Gold We Trust. I think he really started flying the flag for what was going on in the SG, and I personally didn't notice the mainstream media picking up what was going on until Koos started doing this amazing work looking into the deliveries that were starting. It's also worth visiting his site because in the past few weeks he's been looking at some other interesting data and adding to this delivery focus. Koos, I'd really like you to join in as and when you feel like it, or when I'm going off topic or you've got something further to add. Of course, the big news was the delivery that's being seen taken on the Shanghai Gold Exchange. While the Western world were saying that the gold bull is dead, he's on his gold, they couldn't get enough of it, and they would still remain quite high up. Again, this was all brought to our attention because of this data that Koos has kindly put together. At the moment, if you look at the first, I think it's the first graph on the research piece, that you can't even put the Shanghai Gold Exchange, COMEX, and London on the same scale because it's so much smaller, the Shanghai Gold Exchange, than these two other markets. And so at the moment, I think someone asked this question earlier on, the future role of the Shanghai Gold Exchange, it doesn't seem to be immediate in terms of setting the price. But I forgive me, I can't remember who said this a few weeks ago, but someone said that they believe it's only going to take about 3 to 5 years for the Shanghai Gold Exchange to start having a really significant impact on levels of supply and their gold, which will be interesting because, as we've just said, the price of gold at the moment isn't based on physical gold, so the Shanghai Gold Exchange will hopefully be flying the flag for this. The delivery ratio on COMEX, as I said earlier on, has been below 5% for the last 4 years and is currently between 2 and 3%. In comparison, on the Shanghai Gold Exchange, this is consistently above 25%. Koos wrote something quite interesting the other day. I don't know if Koos wants to pop in. He quickly confirmed what delivery actually means on both COMEX and the Shanghai Gold Exchange. And he found that deliveries do not necessarily leave the COMEX vaults. And they don't know how much metal is drained by COMEX by looking at delivery settlements. In contrast, all the data that Koos and ourselves have gathered, it's 100% certain that the Shanghai Gold Exchange delivery numbers are about physical gold leaving the vaults. I don't know if you want to add anything to that, Koos?
Yeah, I will. Is my microphone open? Yes.
Yeah.
Yeah. What I can add is that, I started this investigation or my research at the Shanghai Gold Exchange about, I think, 3 months ago. So I'm kind of new to this, but I was obsessed immediately. And of course, for gold bugs like us, only the physical is important. So I downloaded all the physical delivery numbers and I compared them to COMEX. And then everybody can look at my website. I think last week I published a blog about deliveries on the COMEX compared to SGE. And on the COMEX, because I found a few articles of professional traders, and you can read it in my post, but most physical deliveries on the COMEX don't leave the vaults. It's just you receive a warrant if you get a physical delivery. And with the warrant, you can choose to get it out or leave it in. But most people, this writer of the article writes, most people at the COMEX leave the gold in the vaults of the COMEX. So it's even less, than we think. But I have email contact with an employee of the Shanghai Gold Exchange, and he confirmed to me numerous times, about 4 times, that the deliveries of the Shanghai Gold Exchange all leave the vaults. And today I was looking at, I can pop in a link here. I was doing some research on where all this gold is going to. Like you did also some research on who are the biggest buyers on gold at the Shanghai Gold Exchange. And mainly they're banks, so we can maybe discuss where all the gold is going to. Is it going to the people near the Central Bank of China, or does it end up in the hands of consumers in China? But anyway, in this link I just posted, you can also see that once the gold leaves the SGE vault, come back. So the numbers we have, and it's more than 1,200 tons year to date, it's all physical gold leaving the vaults and doesn't come back. So it's really, it's a huge amount of gold, and I'm really surprised the whole world isn't watching this, and it doesn't influence the gold market in a bigger way. But who knows? Maybe in the future.
Well, exactly. I think there will be something in the future, and I think I'm a bit like you. I feel frustrated that more people aren't when they're sort of on these financial channels saying gold's dead, don't invest. This phenomenal demand going on the Shanghai Gold Exchange, and I think
exactly.
And I think the people that are taking delivery of this gold, whether it's banks, consumers, the central bank. But I do just think that it just shows that we have a nation, if not a continent, that just want to hold this physical gold, whether it's for their personal wealth, or it's consumers, or if it's because they're worried about the international reserve currency, or if it's because they're worried about currencies and the inflation and the leverage state of the country. So I do think that, again, we're seeing them almost preempting their own crisis and worries, but also of a further global crisis on all levels, which again is something that I wish that the mainstream paid more attention to, because it's something that investors here should be looking at and asking why this is going on. Yeah. Do you have anything to add?
No, not really, Koos. I mean, the amazing, as you said earlier, is just how physical it is in its nature. And Rory, you asked earlier about what could be the catalyst for, seizing control or dominance of price discovery away from COMEX in London. This has got to be one of the most attractive places for it to happen. Now, trading and investing in China for whether you're a domestic citizen or an international investor is not exactly as open as the US markets and other markets right now. But if the Chinese plan really is to internationalize their financial markets, internationalize their gold market, or liberate their gold market, you've got to think that some of these key pawns in that game are going to be used. And if the SGE is perceived by investors and traders around the world as one of the most reputable places for actually trading gold, which is properly physical for effortless and quick and seamless delivery, it's a sort of theme we think about with Rafe Hazel, our CEO, as well. It's going to be an attractive destination for investors. Who knows at this time? It's quite interesting looking at your data, Koos, and at Jan's about the largest banks trading on the SGE. There are some foreign names in there that you might recognize, a few French banks, some Australasian banks as well. But they are the biggest guys in the top 10. They're all Chinese banks. So there's the Bank of China, ICBC, the Agricultural Bank, all sorts of banks I haven't even heard of. But at the moment, this is really a Chinese huddle. It's a really interesting potential catalyst for the market at this time. But I guess until you see a broader diversity of participants trading there, we can't yet think this is going to become that wedge between the physical and paper gold price elsewhere.
Maybe one more thing I would like to ask the group. I spoke with you about this before, Jan. Do you think, or anybody else, if this coming gold standard, which is inevitable to me, is it going to be top down, up? That is a question that keeps me up at night. What do you think?
This interests me a huge amount. Before I joined the real asset company, I was this was my first job outside of university. After university, the world could move to a standard, and I believe that it would work in two ways. You would see holding gold, but mainly silver, to store it and wanting to trade in it, and then central banks and larger companies. We said sort of about Russia and China exchanging oil for gold, them using gold, and it would I believe it would almost be a kind of bottom up and top down, and eventually meeting in the middle with smaller companies getting on board and other nations that they trade with. That's how I see it, because I think in China there is no way that anyone could insist that it's just citizens buying gold or it's just the government and central banks buying gold. This is clearly a demand from, as I said in a previous answer, they may well be doing it for different reasons, for individual wealth and want to protect the economy, but it all comes down to the same thing. They want to hold gold because they believe it's money. So I believe that it will be coming from both directions. And also the Chinese government, unlike other governments, are fully encouraging Chinese citizens to own gold. So I think they are prepared for this to be a sort of a mutual move towards this standard.
I agree with pretty much everything Jan just said. I guess the is thing, and for everyone else watching, how and when China and other nations in the East, creditor nations that are emerged, they're not emerging really anymore, they are emerged, how and when they play the chess pieces within this game. The end of a dollar-based financial system for a while, and as they've been growing in their experience of managing large currency reserves, they've worked out what the game is. The Arab nations, who were in a similar position, a number of decades ago, also realised that they were exchanging real assets for paper, and over time they were on the losing end of what you might call a vendor financing loop and the inflationary implications. As commentators like urge regularly, he suspects that the reported gold holdings all over the Middle East are actually far, far lower than they really are. We are now seeing China pulling the same levers. So. Fascinating times, and let's see how they play those pawns on the chessboard going forward.
Has anyone got? I've got a couple of statistics to run through, but I think most people are fully up on the Shanghai Gold Exchange. Has anyone got any other questions they'd like to ask? Mainly Koos, I suspect, because he is the expert on this. Before I go on. Okay.
Koos, whose real name is Jan.
Yeah, two Jans and Jan. So we focused on three main contracts on the Shanghai Gold Exchange, two of which were 1 kilo contracts and one 3 kg contract. And what I found, the first thing I found interesting, which is just a brief tidbit really here, is that there was the demand for 1 kilo contracts was overtaking those for 3 kilos, which is quite a recent change in the market, which again suggests that people are looking for contracts which are more accessible. We focused on the gold T+D contract, which again is a kilo size. This is because it's the one that is most similar to a COMEX future contract, and you can read about why that is on the article. There's an explanation for that. In terms of pricing and premiums, we didn't find any huge premiums, but as I've said before, premiums are quite based on location, and they do have a night session which is supposed to bring them back into sort of international gold prices, but we would like to do more work on these premiums that are being seen. So if anyone's got any data they'd like to draw our attention to, that would be fantastic. I am speeding through this because I think people are quite familiar with all of this. In terms of delivery numbers, whilst it was very high in April, these have been consistently high since 2012. Now, in the 2011 annual report from the Shanghai Gold Exchange, they did say that they don't think the demand is necessarily around price, but it's more seasonal, determined by Chinese holidays, which is something that we've certainly always looked out for in the past, particularly around Chinese New Year, and then in the run-up to that. However, I think activity that we saw in April and in the months since, it suggests that they are becoming a bit more respondent to prices. And in the last few weeks, we've actually seen, I think Keith might want to correct me on this, a small drop in demand on the Shanghai Gold Exchange for gold. This may well be because the price hasn't moved much and people have done all their buying. I don't know if Keith wants to jump in there on his opinions on that.
Well, not really. Like you said, there was a huge spike in April when the price came down at first. Huge physical deliveries, and now it's an average of about 50 tons a week. which is insane, but it's less than in April. But no drop to me. Bloomberg wrote an article today about less physical demand in China. I'm not seeing it. I'm still seeing huge physical deliveries, and yeah.
Because I agree. It's like comparing one very big flood to a slightly smaller flood. Every month of demand is big and is significant. So even if there are some that are slightly smaller than others, 50 tons a week, that's 10 to 20%, depending on how you measure it, of the physical gold, arriving each year on the market. So if the tonnage, I think the figures I saw were falling recently from 106 tons to 99 or 100.
Yeah, it's 101.
Yes, that is a slight fall, but the real figure to look at there is they're still importing 100 tons a month.
So just to conclude, as we've been saying already about the Shanghai Gold Exchange, I really believe that this is where the wedge will come when there is a divergence between the paper and the physical gold markets. So I think these disparities will suggest that people will start looking at gold in two different ways. When that will come, I don't know. It's in the same way people ask you when gold's going to hit $3,000 an ounce. Who knows what will impact that between now and it happening? But I think the Shanghai Gold Exchange is something that we need to keep our eye on, because it's interesting, and I think it's a really prime example of how a gold market should operate. And it's accessible to individuals. There's demand. It can make delivery, and delivery ratios are high. So unless anyone's got any more questions on that, we're going to do a bit more of a Q&A towards the end. I was just going to run through our bit on ETFs, which I think is quite interesting actually, compared to the futures markets. The ETFs, as I said at the beginning, were gaining a lot of attention when the gold price fell back in April. Outflows were being attributed to this fall in price, which, as we've said, we would refer you to COMEX on that issue. In a report released by BlackRock, I think either today or yesterday, they estimate that total net outflows from gold-backed ETFs are around $31 billion. And having said that, as we said before, these financial products only represent 6.5% of total global gold demand. So again, I think when people are saying, look at these outflows, as Will just said, well, look at what's actually happening on the Shanghai Gold Exchange for true evidence of what's happening in the gold market. If there is actually a graph in the ETFs piece that shows you that what makes up this gold market in terms of percentages. World Gold Council are convinced that these products do have an impact on the gold price, but we want to know, well, what is it in relation to COMEX or the London gold market? Sorry, forgive me. So whilst ETFs the fall in ETFs was around 3 times more in terms of tons than it was on COMEX, in percentage terms this is actually significantly less than we've seen on warehouse inventory leaving COMEX, which is, again, people talking tons and percentages. But in percentage-wise, COMEX suffered greater outflows from their warehouses. And as we mentioned earlier on, weekly volumes on GLD, which is the largest of the ETFs, gold-backed ETFs, are around 1/20th of those on COMEX. But the market value of the top ETFs compared to the open index, the ETFs impact the gold price more. And 2 weeks ago, our report was produced a week ago, so 2 to 3 weeks ago, and the ETF holdings in GLD fell to 935 tons, which is a level not seen since the beginning of 2009. And this had been at a peak in just this December just gone. And this was actually a drop of about 30% since the peak, which is interesting because this is in relation to the peak of the gold price. In contrast, iShares, which is the next ETF down, which is significantly smaller, did not have anywhere near this amount of impact since the fall in the gold price. So maybe this is about faith in the lack of that particular offering rather than the product in itself. I don't know. That's maybe up for speculation. What we believe is that we've talked about these huge volumes appearing on the Shanghai Gold Exchange. We don't think that these outflows in ETF signifying a drop in demand. What they're showing is this change of demand, and as we keep hearing, this flow of gold from west to east. And ETF outflows might have totaled, just I think 180 tons in the first quarter of the year, so prior to the gold price smash. But this was just tiny compared to the amount of gold that was delivered on the Shanghai Gold Exchange. And we show a graph of this in our piece. And so ultimately we think that these ETF outflows should be measured against, these significantly larger elevated physical levels of demand around the world, especially in Asia, and also from central banks, because we can't ignore them when we're talking about physical banks. Central banks have consistently bought, even since the gold price. They saw it as an opportunity to grab more, as many individuals did as well. So again, we come back to this change in the nature of gold demand. Interestingly, not all ETFs are suffering. In Japan, the gold ETFs have actually grown 10% in the last year. And I think what this shows is that, again, it's this change in the mentality towards owning gold, no matter what product it's through, in that it's not just there to buy and sell and have a bit of a punt on. It's there to hold on to, because you still have that gold, regardless of what's happening to the price. But having said all of this, these ETFs, whether in India or in Japan, are just a small fraction of the ETFs that we see across the world. I think in India, ETFs only hold 40 tons compared to the 860 tons that they imported physically last year. So they're not a big representation of their demand. Are ETFs easy to own? Is this a good way to own gold? I don't think so. In looking at GLD, they're not accessible. Every 10 shares of GLD represents around one ounce of gold, but in order to redeem these shares for gold, then you must own a minimum of 100,000 shares, which works out as just under 13 million with the gold price today, and it's highly risky. There are at least 3 counterparties involved in the delivery of an ETF product. So this, of course, tends us to look at, what does Mrs. Wong on the Shanghai Gold Exchange, as Max Kaiser refers to her as, what does she want when she's going to be allocating her savings to gold? Well, I pretty much guarantee she hasn't got $13 million to be spending on gold. And so we're seeing this kind of shift in the change in the desire for product, and we think that this gold is what's heading into the east. And again, when you compare it to COMEX in London, the sizes aren't accessible for the majority of these individual investors, and the counterparty risk remains. So whilst there is no doubt that investors in the West who are on GLD, who invest in GLD, have been lowering their gold exposures, sometimes held in the form of ETF positions, we do not believe that these ETF outflows represent a global, worldwide withdrawal of interest from the market. And we believe that, it's just a signal and change in the nature of the demand. And I think this can only be good news, what we're seeing at the moment.
Yeah, Jan, well summarised. I think the ETFs, especially GLD, they're only an effective delivery mechanism if you're a really big player. Lots of the participants and the viewers might know of a hedge fund manager called David Einhorn, who runs Greenlight Capital. He's a famous Lehman short and contrarian investor. He did buy GLD shares, but he took delivery of baskets of them. But I think that tells you that it's an efficient way of buying in size, and to get access to large pools of physical bullion if it works for you, fine. But then he decided, okay, it's a good way to buy the product, but I don't want to hold gold that way. So he took delivery, and no one actually knows where he took delivery to, or who his custodian or his vault is now. But as you say, that's the sort of participant that can use an ETF to take delivery. Other than that, it is a security.
That's the end of our discussion on all of our gold price pieces. I'd love to hear any feedback or any more questions that you've got. I'd just like to just say a couple of concluding comments that we've really enjoyed looking at the nature of the gold market, and we're aware that it is a sort of very broad overview, and if anyone's got any suggestions for further research pieces, then that would be great, send them our way. But I think, whilst the gold price at the moment might be a bit miserable to log on every morning and have a look at it, I think what we're finding is actually quite positive for the gold price in terms of gold demand and how people are thinking about it. At the Real Asset Company, we still continue to see demand for gold, and I think it's because people now see this as an opportunity to get back into gold. Before, maybe they'd felt they missed the boat. So it shows that people still want to own gold, and that hasn't changed, and the reasons for holding gold remain, and hopefully we might see, rather than this movement of gold from west to east, a transfer of this understanding of gold from east to west. Does anybody have any questions, or always email us or tweet us or anything if you want to?
Well, Richard, I just wanted to say thank you very much. I'm sorry for cutting you off with the Sprott thing, but I think everybody, whether it be consumer to sovereign nation, are just positioning themselves. And as you said before, it's going to be a matter of time between now and whenever that magical number is that they rejig the currency baskets, whether it's going to be a mixture of gold and a couple of other currencies. But I think we've just got to wait for a major player like a sovereign nation or a major investment fund to invest in it and take the price. It's been hit. It's been hit every day, and I think we're just waiting. They're obviously doing that to position themselves, and once they've positioned themselves, we'll be ready to see it rocket off.
We certainly will. I think there's someone else had a question.
Yes, I do. This is Rory again. With the Shanghai Gold Exchange moving, approximately 50 tons a week, I mean, annualized, that's 2,500 tons or more. It's like 2,600 tons, actually. And according to some of the analysis that I've read, there's only about 2,400 tons ex-China that are dug up out of the ground each year. So if they're moving more gold than what's coming out of the ground, how is that even possible?
I don't know if Koos wants to answer this one. If you have any thoughts on it.
Yeah, I can share my thoughts. Well, of course, it's possible if other central banks or other owners of physical gold ship their gold to China. I mean, you have an annual mine supply, but you also have 160,000 tons above ground gold on Earth. So a lot of the gold from the West, is heading east, and maybe even central banks are cooperating in this. Of course, it's all speculation, but maybe they are cooperating in dividing up all the gold available and to do a monetary reset. I don't know. I'm just looking at the SGE data and Chinese import numbers, and those are staggering. And the rest is, I would like to hear your opinion on it.
Sorry, was that for us or for
anybody?
Did anybody hear the William Kay interview on KWN from Shanghai, from where he was saying that the Buddhist Bank gold was sent to Asia and they were melting it down in the refineries there and rebranding it with the... So, I mean, I guess that's answered our question. I don't think there is any gold in Fort Knox. If there is, there's very little. And I think that's where the Germany wanted to repatriate its gold, and I don't think they're going to get it. I think the reset's going to happen before they do, and I think that's where you'll find the gold's coming from. It's coming from the central banks, and they're all in it together. And
I agree. Like we said at the beginning, that we just keep hearing all these stories of these delivery bars being melted down, to satisfy this demand in China. And I'd love to see data from the refineries to see how much is going out there, because like you say, we can't see how this is sustainable otherwise. And they are taking delivery of it. It's not like we're sort of seeing on COMEX where it's just sort of quietly being pretended that it's gone out of the warehouse. So it is interesting, and it would be great to if anyone finds out where it's all coming from for definite, rather than all these sort of anecdotal pieces of evidence.
I'll just say I got into gold and silver about 3 years ago, and I'm not naive in any shape, way, or form, but it's suddenly you're wearing the tinfoil hat because you see that every government's manipulating its numbers. It's not just the Chinese manipulating the numbers, it's every government, whether it be local, municipal, federal, and you just have to sit back and look at it and say, well, we're not going to know until they're ready to let us know, but we know that it's corrupt, and they'll never let us know with their accounting practices. We'll never know what gold they've got and where it is, and we'll live in that ideal of that it's there even though it's not. So,
and I agree, but I think one thing we do know is that we should still, and sort of watching these numbers, so that's something that we can at least sort of hang on to, and that we can still be buying gold, because like you say, there are all these concerns, or people know that the governments are corrupt or manipulating figures, but there's nothing we can be doing about it, unfortunately, rather than just producing this research and talking about it, encouraging them to carry out audits and things, but in the meantime sort of look after ourselves and our investments. And like we say, I think we're sort of one of the best informed, as are those in China who are stocking up on it all.
I mean, Richard, I think your comment and question there just throws up a really interesting thing. There's a huge dichotomy in the analysis of the gold market. A lot of people talking in this call here now are deeply educated on why they've got into this position and this correction, which has been really testing for a lot of investors. But for people that really understand the monetary issue at play here, the correction is let's just say easier to get through. Lots of other retail investors might have got stopped out, spooked out. They're thinking, oh, the gold bull market's dead because I read it in the FT or because I read it in the Times. This is the amazing thing. If you look at what's happening with the physical all around the world, which only a really quite small number of investors and people actually do, and it often doesn't get reported that widely, you see really quite a different dynamic. Now, unfortunately, markets can remain irrational longer than people can stay solvent, but for people that really do believe this thesis, and hopefully they don't get wedded to it for emotional reasons, it's just fundamental and practical reasons of good analysis, you've got to think this represents some sort of opportunity. So Jim Rogers is always an investor we like to listen to a lot. He's not a short-term trader. He's not so interested in punting. He looks for big secular bull markets and for theses. He's picked them pretty much perfectly since the 70s, and as he said in September 2011, when the price was rocketing up like that in an unsustainable way, he said, look, this bull market's been too good. It's been 12 years up in a row, 15% up a year on average. We're going to have a big correction here. We've just done a 40% increase in the gold price in about 2 or 3 months. It's got to come soon. Well, we're pretty much there. We're nearly 2 years into it now. So an unhealthy market, you might say, is becoming much healthier as the weak hands have been getting shaken out, and these firm hands who buy on the dips have really turned up. I mean, we saw evidence with our business, but with also loads of other brokerages in the West. After the April gold price smashes, the rush to buy and stock up was really massive. Businesses all over the UK, all over Germany, all over France did record months because people really committed to this idea that gold is money and it's another form of saving, perhaps a superior form of saving. They wanted to load up. So that part of the market is still healthy. If the price can start moving off a low base with these hands holding and the weaker hands shaken out, you might say we've built a healthy base for moves upwards.
I think we've got time for one more question if anybody's got any, but I'm a bit aware of time, and we're going to do some more of these in the future, I promise. So if anyone's got any more questions, give us a shout now.
Anything on digital currencies there, Chris Ellis in London, or anyone else?
Yeah, thanks a lot. Can you hear me?
Yeah, I can hear you.
Yeah. Oh, great. Okay. Yeah, I'm quite new to this market. I only really started getting into it since I met you, Will, a few months ago, and then I started watching the Max Kaiser show, so I bought some silver for the first time in my life. I'd never really looked at it before. And one of the things that really strikes me is the rise in demand of money, how much money itself is in demand. And that's evidenced by not just what you've been talking about, but also the sphere that I'm in, which is cryptocurrencies, namely Bitcoin and Litecoin and Feathercoin and a few others. And really we're seeing the same trend, that China is buying up these very powerful supercomputers that can mine Bitcoin at phenomenal rates, such that the last data I have is about a month old, but an average Chinese citizen could buy a Bitcoin for about $13 cheaper than an American citizen because they had access to cheaper hardware. And so really what I see happening at the moment is everyone becoming their own central bank. It's not about what you own, it's about what you have control over. And a cryptocurrency that's backed against mathematics and also is light and has no counterparty risk, as it's just a bit of data sitting on your computer, is also very attractive to the East. And so that would follow the strong trend that you've been talking about of the flow of wealth going from west to east, particularly as America continues to regulate itself out of existence, such that an American citizen has to pay a much higher price in order to get access to the same commodity.
I think that's valid, and I think we also saw a huge rate increase in the downloads in Argentina last month. Is that you might know more about than I do? So I think, like you say, there is this desire to be holding money that you have control of and that can't be manipulated. And in terms of the China thing, maybe Koos, that's an idea for your next graph, is Bitcoin downloads, the value of them compared to SGE deliveries and Hong Kong imports. So it might be something worth looking at.
Yeah,
you're absolutely right. If the creditor nations and now merged nations of the world have been on the receiving end of a fiat dollar system for decades now, they're going to look for alternatives. Gold, is valuable because it's decentralized. The supply is controlled by nature. Bitcoin is decentralized in another way. We're in such early days of digital currencies generally, so who knows what and where they'll go and which one will win out. But it's all welcome competition from centrally planned money. This is just a digital solution. I'm sure you've heard it described as gold with ones and zeros.
Yeah.
So China again's got to look at it. It's another angle here, and it's another thing that's a potential. Let's just not call it a threat, but potential competition to the dollar and other government-issued money. So they've got to have a look.
I think whoever does the best job of defining what money is in the next few years will probably be the winner. I think this is all about us trying to re-understand. If money doesn't actually reflect the value in the real economy, then it doesn't really serve its purpose. If there are more banknotes than there is products and services, then really it boils down to, I mean, I don't know the technical terms, but really it boils down to the people who get the money first, because surely they have the advantage. And if that's the central banks, and there's no merit, really all I see cryptocurrencies as is just geeks printing their own money. This is just QE by sociologically another group of people, except of course this is distributed to anyone who knows how to switch on a computer, which to me seems more meritorious. I don't know what you think, but it kind of goes well with gold anyway, because people can sell their gold on one side of the border for Bitcoin and go to the other side with a password in their head and then buy it back on the other side. So I think these two things can complement each other quite well.
I see them complementing in terms of, I think the debate should be open to competing currencies. That's how I see it going, and not necessarily that there would be a winner, but in terms of, it would be great to see that shops could take different currencies and things. But I do think this is a discussion for another hangout.
Definitely.
But I think that's how I would see gold and Bitcoin, being used, and also Bitcoin, you can use it for so many things now to buy across the internet, whereas gold's still quite restricted in that respect. So one's maybe a savings mechanism, the other one's for your, your day-to-day currency. So just using them in tandem like that is how I would see them anyway. But I'd just like to thank you all for coming this evening. It's been great, and thank you so much for hanging around and all of your fantastic questions. Any feedback you have, please let us know. Emails, tweets, however you want to contact us, and we'll be doing one of these in the near future. And also, any ideas for research, please send them our way, because we're always looking for new ideas that will interest you. And particular thanks to Koos Jansen for all of his help with our Shanghai Gold Exchange. And next time, I'll give him a bit more warning when we're asking him so many questions.
And thanks to Brian Lucey as well, who did join us for a bit, and who just kindly tweeted us saying sorry he had to dash. So thanks all for joining, and see you next time.
Thank you.
Great. Thanks.
Bye.
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 Bye now.
Thank you.